Seven Deadly Innocent Frauds of Economic Policy by Warren Mosler. Interest Rates and Monetary Policy. It is the realm of the Federal Reserve to decide the nation's interest rates. I see every reason to keep the risk-free interest rate at a minimum and let the market decide the subsequent credit spreads as it assesses risk. Since government securities function to support interest rates and not to finance expenditure, they are not necessary for the operation of government. Therefore, I would instruct the Treasury to immediately cease issuing securities longer than 90 days. This will serve to lower long-term rates and support investment, including housing. Note, the Treasury issuing long-term securities and the Fed subsequently buying them, as recently proposed, is functionally identical to the Treasury simply not issuing those securities in the first place. I would also instruct the Federal Reserve to maintain a Japan-like 0% Fed funds rate. This is not inflationary, nor is it the cause of currency depreciation, as Japan has demonstrated for over 10 years. Remember, for every dollar borrowed in the banking system, there is a dollar saved. Therefore, changing rates shifts income from one group to another. The net income effect is zero. Additionally, the non-government sector is a net holder of government securities, which means there are that many more dollars saved than borrowed. Lower interest rates mean lower interest income for the non-government sector. Thus, it is only if the borrower's propensity to consume is substantially higher than that of savers does the effect of lower interest rates become expansionary in an undesirable way. And history has shown this never to be the case. Lower long-term rates support investment, which encourages productivity and growth. High risk-free interest rates support those living off of interest payments, called rentiers, thereby reducing the size of the labor force and consequently reducing real national output.